Hello, fellow investors, and welcome back to Market Matters Media. Today, we're diving into the world of dividend investing, exploring the path to earning an extra $1,000 a month in passive income. Imagine your bank account growing without any extra effort on your part. It's the magic of dividend investing. Now, $1,000 a month may not seem like a fortune, but the beauty lies in its passive nature. In this video, I'll guide you on how to achieve this financial milestone, breaking down the steps, strategies, and mindset needed to make it a reality. Stick around because by the end of this video, you'll have a clear roadmap for your dividend investing journey. Before we dive into the specifics, let's address the elephant in the room: the common misconception that reaching $1,000 a month is an insurmountable goal. The secret weapon in our arsenal? Compound interest. We're not aiming for an immediate $1,000. Instead, we start small, rolling a modest snowball that gains momentum over time. It's the eighth wonder of the world, as they say. So how do we get started? Let's take a look at McDonald's stock as our guiding example. The first crucial factors to consider are the forward dividend and payout ratio. McDonald's forward dividend is $5, resulting in a 2.3% dividend yield, a respectable figure in today's market. Next up, examine the company's earnings. McDonald's currently earns $6.33 per share annually, with a payout of $5. It's essential to ensure earnings consistently exceed dividend payouts, indicating financial health. Additionally, scrutinize the dividend history. In McDonald's case, a positive trajectory over the past 12 years is promising, though a cautious eye is kept on a decrease during the last recession. But don't stop there. Don't overlook the quality of the company itself. Consider its future outlook, competitive advantage, and potential for growth. As Warren Buffett advises, invest in companies with a strong competitive edge. We'll use these criteria to filter through potential dividend stocks. Now, you might be thinking, I don't have hundreds of dollars to invest in McDonald's stock. Fear not. Start small with affordable options like Bank of America, Coca-Cola, or AT&T. The key is to develop the habit of investing, redirecting funds from daily indulgences to wealth-building opportunities. The investing mindset differs from the norm. Instead of seeking short-term gratification, envision the long-term benefits. Skip that daily Starbucks coffee, brew your own at home, and redirect the savings to your investment portfolio. It's about making decisions that align with your financial goals. Now, if you're finding value in this information, consider subscribing to Market Matters Media. We regularly share insights on wealth building, investing strategies, and financial empowerment. Your subscription not only supports the channel but also ensures you don't miss out on valuable content. Let's shift gears and explore some dividend stocks to kickstart your investment journey. 3M offers a 3.5% dividend yield and boasts an impressive track record of increasing dividends for over 61 consecutive years. Another solid option is PepsiCo, with a 3% dividend yield and a 48-year streak of dividend increases. Now, the burning question: how much do you need to invest to reach that coveted $1,000 a month in dividends? Realism is key here. Assuming an average 3% dividend yield, you'd need a total investment of $400,000 to generate $1,000 a month. It may seem daunting, but remember the snowball effect. Start small and let it grow. Being a successful dividend investor requires more than average effort. Strive for excellence in selecting companies with reliable dividends, a strong history, and a promising future. It's about playing the long game, emulating high-quality investors like Warren Buffett. Now let's delve deeper into the essence of dividend investing. It's not just about picking stocks. It's about building a diversified portfolio that stands the test of time. Consider this as crafting your financial masterpiece, with each stock contributing to the symphony of wealth creation. Diversification is your ally. Instead of putting all your eggs in one basket, spread your investments across various sectors. This approach safeguards your portfolio against industry-specific risks. Imagine if one sector faces a downturn. The impact on your overall portfolio is minimized. For instance, you might include technology stocks for growth potential, consumer staples for stability, and healthcare for resilience. By strategically diversifying, you ensure that your dividends aren't solely dependent on the performance of one industry. Consistency is key in dividend investing. Treat it like a financial fitness regimen. Set aside a portion of your income regularly for investments. This disciplined approach compounds over time, much like the dividends themselves. It's not about timing the market, it's about time in the market. Here's a pro tip: reinvest your dividends. Instead of cashing them out, use them to purchase more shares. This accelerates the snowball effect as your invested capital grows, and subsequently, so do your dividends. It's a cycle of wealth creation that gains momentum over the years. Many companies offer dividend reinvestment plans or DRIPs, allowing you to automatically reinvest your dividends in additional shares. This hands-off approach simplifies the process, ensuring your money keeps working for you without requiring constant manual intervention. Dividend investing is not a get-rich-quick scheme. It's a journey. Patience is your ally. The real magic happens over the long term. As you consistently reinvest dividends and stay committed to your strategy, you'll witness the gradual but steady growth of your passive income stream. One underrated aspect of dividend investing is the psychological advantage it offers. While the broader market might experience fluctuations, the reliable stream of dividends provides a sense of stability. It's like having a financial anchor, weathering the storms of market volatility. Now let's address some common concerns about dividend investing. One worry is market downturns affecting stock prices. It's true, markets can be unpredictable. However, high-quality dividend-paying stocks often exhibit resilience during economic downturns. Companies with a history of increasing dividends demonstrate financial strength and stability. Another concern is the impact of inflation on the purchasing power of your dividends. Fear not. Dividend investing can act as a hedge against inflation. Quality companies tend to increase dividends over time, outpacing the rate of inflation. This means your passive income maintains its real value, ensuring your financial security. Let's touch on the tax advantages of dividend income. In many jurisdictions, qualified dividends receive preferential tax treatment. This means you could potentially pay lower taxes on your dividend income compared to other forms of earnings. It's a tax-efficient way to grow your wealth. Dividend investing isn't limited to your local market. Thanks to globalization, you can explore opportunities worldwide. Consider dividend-paying stocks from international markets to further diversify your portfolio. Just ensure you understand the tax implications of investing in foreign stocks in your specific location. Staying attuned to market trends is vital. Industries evolve, and so should your investment strategy. Keep an eye on emerging sectors and technologies. Being adaptive allows you to capitalize on new opportunities and adjust your portfolio accordingly. Now let's dive into the nitty-gritty of financial ratios. Beyond the dividend yield, ratios like the price-to-earnings or PE ratio and debt-to-equity ratio offers insights into a company's financial health. A low PE ratio may indicate undervaluation, while a manageable debt-to-equity ratio suggests prudent financial management. For more advanced investors, consider exploring options trading as a complement to dividend investing. Strategies like covered calls can enhance your income by leveraging your existing stock positions. However, remember that options trading involves additional risks and requires a deep understanding of the market. Economic indicators provide valuable cues for dividend investors. Keep an eye on factors like interest rates, GDP growth, and unemployment rates. These indicators influence the overall market environment and can impact the performance of your dividend stocks. As we conclude, let's answer community questions. Investing requires ongoing learning, so ask away. For future video topics, comment below. Today, we delve deeply into dividend investing. Congrats on advancing your financial knowledge. Please like, share, and subscribe to Market Matters Media for more insights. Thanks for joining our community. Each investment in dividend ventures moves you towards financial freedom. Happy investing!